Yesterday, both the euro and the British pound extended losses against the US dollar. Data on consumer prices in the euro area was the focus of market participants. Headline inflation in the eurozone fell to 8.5% in February, down from 8.6% the previous month. The reading was well above the 8.2% forecast from economists. This indicates that the European Central Bank will have to stick to its aggressive monetary policy. Many expect the regulator to raise its deposit rate to as much as 4% by early 2024. These facts may act as a driving force for the European currency. However, given that the global economy once again faces the risk of high inflation and the Fed also keeps its monetary policy tight, similar steps by the European regulator will probably take a back seat. Investors may interpret this as a sign of a recession, which in turn will put pressure on the euro. Yesterday's statistics on the US labor market met market expectations. As a result, the dollar remained in demand. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. It includes data on Germany's trade balance, but this report is unlikely to have a severe impact on market sentiment. Traders should pay attention to PMI reports from the euro area and its member states. The indices are forecast to increase, indicating expansion in the services sector. Against this background, downside momentum may fizzle out, thus allowing the euro to turn positive. The UK is set to release similar data on services industry activity. If the indicators top estimates, the British pound may enter a strong bullish correction. In the second half of the day, market participants will receive Purchasing Managers Index figures from the United States. Statistics are expected to be upbeat. However, this will hardly support the greenback as it is extremely overbought. The market is long overdue for correction, which is the most likely scenario for today. Traders may also take notice of speeches by Fed and ECB members. However, I doubt they will say something new. From a technical point of view, the 1-hour Euro-American dollar chart shows that the levels of 1.0598 and 1.0630 act as intermediate support and resistance respectively. Thus, it is worth focusing on this range. A false breakout at 1.0598 following the release of PMI data will create a buy signal. In this case, the euro will rise to 1.0630. If the price breaks through this level and tests it from the top down, the volume of long positions will increase further. Thus, the way to 1.0660 will open. At this mark, I recommend going short on a rebound to catch an intraday correction of 20-25 pips. Short positions at 1.0630 can be considered only amid a false breakout. Alternatively, going short will be relevant after the price returns below 1.0598 and tests it from the bottom up, weighed down by upbeat data on US services industry activity. Under this scenario, the pair is expected to break through 1.0568 and probably 1.0535. At the level of 1.0535, it would be a wise decision to go long on a rebound. Long positions at 1.0598 and 1.0568 can be opened only in the event of a false breakout. Meanwhile, the British pound is trading around February lows. The price has rebounded slightly but still failed to gain strong upside momentum. A decline followed by a false breakout at 1.1956 will create a buy signal. In this case, the pound sterling is expected to advance to 1.1994 if the price consolidates above this level and tests it from the top down, supported by positive statistics on activity in the UK services sector. An additional buy signal will be generated. Thus, the pair will recover to 1.2031. At this mark, traders are recommended to go short on a rebound to catch an intraday correction of 25-30 pips. Short positions at 1.1994 can be considered only amid a false breakout. The level of 1.1956 can be seen as a target. A return below this mark and its bottom to top test in early trade will make it possible to sell the pair, counting on a drop to 1-month lows. If the British pound falls below 1.1917, it will probably head towards 1.1875 and 1.1829. At these levels, traders may go long on a rebound in the hope of catching an intraday correction of 25-30 pips. Going long at 1.1917 will be relevant only in the event of a false breakout. Good luck and have a nice weekend.